Okay, so you want to own a car wash. It sounds like the easiest business on the internet right now. Recurring monthly revenue from people who sign up once and mostly forget they're paying. Barely any staff because the machines do the actual washing. A product nobody can put off forever because dirt doesn't care what the economy is doing. For the last few years, half of financial YouTube and TikTok has been telling you the exact same thing. Buy a boring business. And a car wash is about as boring and supposedly as good as it gets. Here's the problem. That exact pitch just got tested at a scale nobody had tried before by some of the most sophisticated lenders and investors in the country, backed by hundreds of millions of dollars. And it broke. Publicly, quickly, and in a way that tells you almost everything about how this industry actually works underneath the subscription emails. So before you buy the pitch, it's worth understanding what you'd actually be buying. A car wash is one of the only assets on this list where a regular person could plausibly write the check themselves. At the bottom end sits the self-service wash, the kind with coin-fed bays where you spray your own car down. These can be built for a few $100,000, and while they will not make you rich, the operating costs are so low that even modest revenue, often somewhere between $40,000 and $100,000 a year, can turn a genuinely healthy profit margin. One tier up is the in-bay automatic, where your car sits still and the machine moves around it. Equipment alone runs anywhere from $100,000 to well over $1 million, depending on the technology, with annual revenue typically landing between $200,000 and $500,000 a site. But the model that has actually taken over the industry, the one every private equity firm on Wall Street has been racing to build, is the express tunnel. Drive in, stay in your car, conveyor pulls you through, out in under 5 minutes, sold almost entirely on a monthly membership. Building one from the ground up runs $3.5 to $10 million or more once you count the land, the tunnel structure, the equipment, and the water reclamation systems most cities now require. Converting an existing full-service wash into an express tunnel runs around $3 million on its own. That's still nowhere near the hundreds of millions it takes to open a mall or a bank, but there's a second, quieter divide that matters just as much as the price tag: how you're actually financing it. The small independent operator is almost always going through the Small Business Administration. The SBA has guaranteed nearly $7 billion across more than 5,000 car wash loans since 2010. And those loans have historically performed better than the average small business loan, not worse. The institutional chain, the one buying up dozens of locations at once, is financing very differently. Leveraged acquisition debt stacked on top of a financial trick we'll get to in a minute. Those are, in practice, two completely different businesses wearing the same sign out front. There are now roughly 60,000 car washes in the United States, about twice the combined store count of McDonald's and Starbucks. And the story of what just happened belongs almost entirely to the second group. Not everyone in this business is chasing hundreds of locations. Brian Kruss, a former Marine Corps explosives technician turned banking recruiter, bought a struggling car wash in Northeast Ohio, turned it around, and then did it again and again. Today, his company, Sergeant Clean, runs 15 locations across the state, built one reinvested dollar at a time, rather than one leveraged acquisition at a time. Worth remembering before we get to the machine that broke. The underlying business genuinely works. What broke wasn't washing cars, it was how fast some owners tried to scale the washing of cars. So how does a modern car wash actually make money? There are 3 layers stacked on top of each other, plus one financial mechanism sitting quietly underneath the whole business that almost nobody watching this has ever thought about. The first layer and oldest is the one-time wash. A customer drives up, pays somewhere around $15, and drives off. Simple, transactional, and at any well-run express tunnel, an increasingly small share of total revenue. The second layer is the one that has completely reshaped the industry, the subscription. Pay a flat monthly fee, typically somewhere in the $20 to $40 range, and wash your car as many times as you want. It's the exact same trick that turned software, razor blades, and meal kits into recurring revenue machines, except this time it's bolted onto a giant mechanical tunnel full of foam and spinning cloth. At scale, this can dominate the business entirely. One major chain built a membership base of roughly 625,000 subscribers, generating more than 2/3 of its total revenue before a single customer had paid for an individual wash that day. The third layer is the upsell: tire shine, undercarriage rinses, ceramic coatings, extended protection add-ons, 30 extra seconds in the tunnel that cost the business almost nothing and carry enormous margin because the marginal cost of a little more spray is close to zero. Depending on the format, a well-optimized site can run adjusted cash flow margins anywhere from the mid-30s to the high 60s in percentage terms, genuinely extraordinary for a business this simple to explain. Stack those three layers on a single, well-located site, and it's easy to see why so much capital chased this business at once. One-time washes providing a revenue floor, a subscription base providing the core, upsells adding pure margin on top, all generated from a piece of real estate smaller than a basketball court, staffed by 3 or 4 people at any given moment. And then there's the fourth layer. It has nothing to do with washing a single car, and it's the part almost nobody talking about buying a boring business ever mentions. Here's what almost nobody watching this realizes. A huge number of the car washes you drive through every week are actually not owned by the company whose name is on the sign. The trick works like this. A company spends $6 or $7 million building a brand new express tunnel on a great corner lot. The moment it opens, instead of holding on to that land and that building as an asset, they sell it to a real estate investment trust or to a private buyer running a tax-deferred exchange for close to what it cost to build. Then they sign a long-term lease on the building they just sold and pocket the sale proceeds as cash. That cash becomes the down payment on the next site, which gets built, sold, and leased back, which funds the next one after that. One major operator alone completed close to $135 million in these sale and leaseback deals in a single recent year, and that's just one chain among dozens running the identical playbook across the country. It is a genuinely clever way to grow fast without raising an equivalent amount of new equity every time you want to open another site. It is also, as it turns out, exactly how you build a 260-location company that owns almost none of its own real estate and owes rent on nearly all of it. Because here's what a sale-leaseback actually creates on the other side of the ledger: a fixed cost, not a mortgage you could renegotiate, not land you could quietly sell off if one site underperforms, a long-term lease, typically running 10 to 20 years, with rent that climbs a little each year, regardless of how many cars come through that particular tunnel that particular month. That's manageable in a stable market. It is not manageable in a wildly oversupplied one, and this industry became wildly oversupplied extremely fast. Private equity poured millions, $750 million into the sector in a single recent year. Express tunnels, which controlled essentially none of the market 15 years ago, now control more than half of it, while full-service washes have collapsed from roughly 80% market share to somewhere near 15%. At the height of the building boom, developers opened nearly 1,000 new express tunnels in a single year. In market after market, 3 or 4 competing tunnels opened within a couple of miles of each other, all chasing the same finite pool of local subscribers. When that happens, individual site volume drops, and membership growth slows or reverses as customers get poached by whichever new tunnel down the street is running a cheaper introductory rate. But the rent on that site does not drop. Neither does the debt service on the loans that financed the acquisition spree in the first place, especially the portion carrying a floating interest rate that moves against you the moment borrowing costs rise. And here's the part that makes the trap even tighter. As capital markets cooled, the sale-leaseback escape valve itself got more expensive too. A cap rate is roughly the annual rent as a percentage of the sale price. The lower the number, the more a buyer is willing to pay for that same stream of rent. The same real estate that traded at cap rates near 5% at the 2022 peak now clears closer to 6.5%, meaning buyers pay less for the identical lease today than they did 3 years ago. The trick that funded the whole expansion started returning less cash per site, right as operating performance was weakening at the same time. Two of the biggest costs in the business, rent and debt, stayed exactly the same size, while the revenue meant to cover them and the escape hatch meant to refinance them both got smaller at once. The industry's own forecasters have noticed. One widely cited model now projects the entire U.S. car wash market to shrink slightly, at roughly 0.3% a year, from around $19 billion in 2026 down toward $18.9 billion by 2031, the first time in the industry's modern history that the base case points down instead of up. Deal activity has already cooled to match. The number of car wash acquisitions completed fell by nearly half in a single recent year, even as the biggest platforms kept buying.
Because a fund that has to exit on schedule needs to keep showing growth whether or not the market actually has room left for it. A wash with a full parking lot and a healthy-looking subscriber count can still be quietly losing money on the lease alone. Which brings us to Zips Car Wash. By early 2025, Zips operated more than 260 locations across 23 states under 3 brands, Zips, JetBright, and Rocket Express, employing around 1,800 people. Its Unlimited Wash Club had grown to roughly 625,000 members, generating more than 2/3 of the company's $303 million in annual revenue. On paper, this was the picture-perfect version of the pitch. Predictable, recurring, subscription-driven cash flow at real scale, built by private equity firm Atlantic Street Capital. Underneath that picture sat $654 million in debt, the fuel behind the acquisition spree that got Zips to 260 locations in the first place. All of it needed servicing every month on every site, whether that site's local market had 1 competing tunnel or 4. The loans matured at the end of December 2024. As late as September of that year, the private credit funds holding that debt were still marking it at 93 to 95 cents on the dollar, confident it would be repaid close to in full. They did not see what was coming. Zips could not refinance on workable terms in a market that had gotten more crowded and more expensive to borrow in at the exact same time. On February 5, 2025, the company filed for Chapter 11 bankruptcy in Dallas, with a restructuring plan already negotiated alongside its lenders. The restructuring took 84 days. Ownership transferred entirely from Atlantic Street Capital to the term loan lenders who had financed the expansion in the first place, in a debt-for-equity swap that cut the company's debt load by roughly $279 million. And as part of that restructuring, Zips did exactly what the hidden trap predicts. It rejected the leases on 41 locations, walking away from long-term rent obligations on sites that could no longer justify their fixed costs against falling local volume. Zips emerged from bankruptcy at the end of April 2025 with a new chief executive and a smaller footprint, and the legal fallout, claims, disputes, lease appeals, was still working through the courts more than a year later, into March 2026. Zips's own chief executive heading into the filing, Kevin Nystrom, later pointed to a deeper shift underneath the numbers. The whole industry had spent years pushing customers from a do-it-yourself mentality to a do-it-for-me one, funded by a wave of new capital that quietly assumed that shift would keep accelerating forever. It didn't have to reverse to break the model, it only had to slow down. And Zips was not one bad operator making one bad call in isolation. The same softening was showing up at Mr. Car Wash and at Driven Brands, 2 of the biggest names in the industry, both publicly adjusting their own growth plans at the same time. The entire sector had scaled itself on the same fixed cost structure. Zips is simply the chain where it broke first and loudest. There's a strange silver lining sitting on the other side of all this. As the leveraged chains retreat, the buyers still active in this market have shifted to paying up for growth pipelines, to picking up distressed single sites and small chains for less than it would cost to build them today. For a disciplined operator with clean financing, the wreckage of somebody else's leverage has arguably made this a better time to actually buy a car wash than the boom itself ever was. So, does owning a car wash actually work as a business? For plenty of operators, genuinely yes, especially the independent owner who bought the land outright, built in the right location, financed it conservatively, and never got pulled into the acquisition arms race. That version of this business is exactly as boring and exactly as good as the internet says it is. But the version Wall Street bought into over the last 5 years was never really a car washing business at all. You didn't buy a car wash, you bought a subscription business that doesn't even own the ground it's standing on.